Hello, everyone. This is David Russell, Global Head of Market Strategy at TradeStation. It is great to be with everyone. Welcome to Market Trends. We do this webinar every Thursday at 2 p.m. Eastern, so it's great to be with everyone. I wanted to start off by showing you some disclosures at first. And also remember, if you go to tradestation.com and you go to the Insights button at the top of the page, it will take you to our blog. And on the blog, we have a blog post with some of the key points today we're going to be talking about. It's interesting, though, to see Bitcoin moving about $1,000 in the last 15-20 minutes from 68 to 69,000. I'm kind of watching that. Kind of came down and made something of a triangle after kind of chopping at that old level from the last bull market. All right, so great to be with everyone. Here's our TradeStation platform. I'm going to start off very quickly by showing some of these standardized returns. We are going to be speaking about some ETFs, so it's good to also see their standardized returns. If you want to just take a quick look at that. It's good to be back with you. All right, so let's take a look here at tradestation.com. And I'm also going to add a few things into the chat. Go to Insights, and you can see here this article, Bulls Pivot from Rate Cuts to Economic Growth. And we're going to that's the summary of today's webinar we're going to go through, and I'm going to just share some information with you guys in the chat. Make sure to use the chat if you have any questions you want to address, just some disclosures and other things like that. Okay, so as we look today, these are interesting patterns that keep playing on the S&P 500, and we did a screenshot of this chart, and it worked out more or less as we have been kind of looking at last night. So I want to show you, this is the same blog more or less. Now, it's some really interesting confluence at this level where we held earlier this week. So basically, there are three indicators we've really been watching to define this trend since the breakout started in January. The first has been the rising 21-day exponential moving average that we have just consistently remained above. We pulled back near it and bounced again each time. We haven't actually closed under it since the breakout occurred. In fact, I think the only time we closed under it was back here right after like the holiday week. So we've been above that 21-day exponential, and so we held that. Next, the 9-day rate of change has pretty much refused to go negative and stay negative. Slightly negative here for 2 days in a row. It's interesting to see that, but I think overall the key thing is that this has remained in a spot where the direction has been confirmed by things like even the short-term rate of change. We've been unable to put together strings of losses for very long. And the other thing is RSI. It's just remained here between this kind of 54 and 70 reading. And as we've said before, this is all very reminiscent of 1995. This is more or less, if you go back to the late 90s, we've talked about this before, but we saw similar patterns like this, back when the S&P, was in the great bull run of the mid 1990s. We basically saw RSI back in 1995 just go up and stay in an overbought condition for a long time. And if you look at back here, this rally, the big rally that started in 1995, you can see we followed that 21-day exponential, the gold line on the chart. You can see that the same thing, 9-day rate of change, really refused to stay negative for very long, many times. And then RSI just more or less stayed above like 53, 54 the entire time, went overbought, came back, went back, overbought, just kind of kept moving around there. So, I mean, these patterns, we've kind of seen before. And again, it is a similar setup because we have a situation of the expectation of a soft landing after a fit of inflation and interest rate hikes, stuff like that. Now, one other thing that was unique about this week, I have a Fibonacci retracement here, a 50% retracement. So if you look at the weekly move we had from March 15th to the high of the following week, the halfway mark on that move was right here around 51.88. And that was also the high from this week here. So it's interesting to see that we had an old resistance becoming new support, and it also was a 50% retracement of a weekly move. So all those things together occurring at a time when it was near the 21-day exponential moving average is pretty interesting. So I think, in some ways we're seeing these patterns continue to assert themselves. And like I've said, on many cases here, what we're seeing just very tight pullbacks. We're not seeing any kind of difficulty in terms of following through to the downside. And, just sellers don't multiply, buyers emerge, and there is not follow through to the downside. Pullbacks are tight. If anyone wants to just quickly confirm with me that you can hear me okay, this is the one thing I'm not always sure. I'm pretty sure my sound is working, but if anyone wants to confirm it, I would appreciate it. All right, so now those are the main things I wanted to just kind of show you here. I want to look at some intraday, some intermarket analysis, and I'm going to very quickly go to my trading view chart because I keep some things up on that chart that are interesting. There's two non-S&P charts that I think are important. First, we have the 10-year Treasury yield. We have made a big emphasis on this level here around, this, what is it? It's around it's 432. And basically that level goes all the way back. Jump to a monthly here. You can see that level goes all the way back here to June or August of 2007. No, I'm sorry, goes back here to this level. Back here, this level of June, May 2008. It was this line from back there when the market was crashing after the subprime. It was a high on yields, and I don't have it reaching back that far in this chart, but basically it was right around there. And the key thing is that we have been kind of chopping at that level here. Let me just put it back where it was. Sorry. This is an important long-term level. And what's interesting is look at how we peaked there in August, went back under it. It was peak again in February, and now we're sneaking back toward it. And I think it's interesting to see, are we going to close under it? And it's been interesting to watch the kind of price action today as a kind of sense of that. And I think with the, with payrolls and everything else coming up, this is to me an important thing. If we manage to get back under this, that will be a sort of signal of what of market's expectations for interest rates. And then the other thing that is important is the dollar index because this had something of like a double top here, and I'm just kind of watching this because for a long time I thought that a lot of the fundamentals argued in favor of a stronger dollar. The American economy is much better than the European economy right now, and that the Fed was going to be cutting 8 times, and now they're cutting 5 times, and they're cutting 3 times, and the dollar has not rallied on that. And to me, it was interesting to see the the relative weakness in the dollar. So I think right now, watching this double top on the dollar index around 105, and watching TNX around 432 with tomorrow's non-farm payroll could be pretty important in my view here. If we start to see break lower in yield, break lower in the dollar, that could be something that could signal that we're entering a kind of or market that is going to be a weak dollar market, which could be, that's historically going to be something that's going to be favorable for risk assets. It's something that also would argue in favor of more strength in some of the precious metals and things like that. We've seen a lot of the material stocks that are now performing. We've been discussing now for a month or two. I think this is actually kind of an important thing to watch these intra-market levels to kind of have a sense of whether that macro, sort of weak dollar trade is going to come together. If that mega weak, that mega macro story of a weak dollar and lower interest rates really does get confirmed and play out, it has such wide-reaching implications of things like gold and silver and metal stocks and material stocks, and a lot of those can give potential opportunities, especially for people who want to be using options and stuff. So we'll be returning to those in the future. I want to just emphasize that this is, I think, really important to be watching here if we get this confirmation of the downside in the dollar, because the dollar, based on what you see, even the information I have here in my rundown today of the improving economic data in the United States. If you look at most of the data we saw this week, the manufacturing data was stronger than expected. The ISM manufacturing, the ADP payroll surprise to the upside. We saw higher prices here in the ISM. So these things right now, are not consistent with a weaker dollar. So I think it's really important if the market goes the other way, it could turn into something where the market is simply anticipating stuff that could actually be a wide-reaching and longer-lasting trend. Nonetheless, that's really where I am right now in terms of just looking at the S&P 500. It was interesting because I see a certain pattern popping up in a lot of the bigger Nasdaq names that were very interesting to me. And I've been kind of looking at this. I'm using TradingView right now, just very briefly, because I do markups on those. I don't normally do markups on my TradingView charts, on my TradeStation charts for this blog and keep them. I usually do markups on this one because I look at this one all the time. Anyway, so this sort of pattern is like falling trend line and then also holding near term support. This has also been interesting on some of these larger names. I've seen it on this name, on Meta. It to a certain extent has also appeared on Microsoft. We have been talking about these trend line breakouts in Microsoft. Same sort of thing when you see it going down and holding. Another pattern that continues to happen. We talked about the 21-day exponential moving average on the S&P 500, but it's also a pattern on some of these. Look at how this stock comes down, hits that 21-day exponential moving average, and rallies off of that. Same thing with what Meta was doing. Oops. Meta here, it had, hit that, it was, holding 21-day exponential, rallied. So remember, we can use this. We can find these using the workspaces we share with you guys. So just really quick reminder here, if you go up to the top of our blog and you go to the downloads here, that download is a zip file and it contains many items. And one of the items, it includes a series of ELDs, which are TradeStation basically indicators that you can then load them into your TradeStation platform, and they will then empower certain kinds of scans on the workspaces. So here on our MT main, we have something called MA tools. So if you look at something like Meta or Apple, I'm just showing some up now because this would have worked yesterday. But if you look at some of these, you can see when they're touching the 21-day exponential moving average, they actually light up and tell you right here. I'm going to just pull in the whole NASDAQ 100 so you can see and how it works. I've shown you guys this. I've shown this to you guys before, but I want to just emphasize that I'm always looking at this. So yesterday, as I was preparing and doing my blog for this, I basically was looking for things, and I'll just show you right off the bat. This blog post was written yesterday afternoon, so all the information you see down here in the signal scan was based on information from yesterday. So we basically mentioned applied materials. This was one that, look at how it was at its 21-day exponential moving average, and today had some follow through on the open. DraftKings, DKNG, same sort of thing. It was holding that 21-day exponential, rallied off of that. So this is a useful indicator to have running in your radar screen all the time. So if we just look at it here, we can see, let's see, it's going to populate. You can see these stocks right now. So here, KLA 10 core. Now, when it's green, it means it's a rising 21-day exponential. So if we look here in our chart, KLA also is kind of holding that 21-day exponential. So these patterns keep popping up, and I did want to mention that if you look at that radar screen kind of each afternoon for the S&P 500 or for the big stocks you like or the Nasdaq 100, little things might pop up that next day can be potentially kind of continuing on a trend. So it's a useful um, it's a useful indicator to be going to, like an everyday sort of little check. All right, so Meta, Microsoft, Netflix also. So I've talked before about, you have kind of like in the Nasdaq, you kind of have these mega caps. There's a few that are still really performing. Netflix doesn't get the respect that maybe some people would think it. The way it's been performing, it doesn't have as nearly the kind of options activity it used to have. It's not as prominent, but it continues to be working. Now, remember, this company changed their business model to work better for supporting advertising, an advertising-based business model and some other things. And I think it's really important to kind of to remember that when you change your business model, it can have all sorts of interesting impacts on your business, on your margins, and on your profitability. And we talked about the 7 catalysts for stock movement, business transformation being one of them. It continues to work in Netflix. So I think it's just important to remember it here that you have your Netflix, Meta, Microsoft, Amazon. These are all trading very similarly. Look at how they're trading along, holding that 21-day exponential. And in many cases, they're having these like tight breakouts of these falling trend lines. Like this one had, you could also see on this one, you had a trend line in place. So anyway, I want to just mention that because when the patterns move together, it kind of tells you that there's probably certain people who are viewing them the same way, and then you have your other kind of struggling stocks like Apple and stuff like that, and Tesla, obviously. So I want to just kind of emphasize the fact that there are still that group in the big tech stocks that are starting to continuing to perform, and then we have the ones like Apple, Tesla, and there was the one other that I can't remember. Google has kind of been coming back more recently. It's its own story. But last week, also 2 weeks ago, hope everyone had a good Easter. I was not here last week, but the week before Good Friday, 2 weeks ago, we had actually talked about Nvidia. I'm sorry, Dell Technologies coming off this level down here, and basically look at the continuation we got on this. Again, we were just looking at the stocks that had been pulling back to moving averages that brought some signals. So these tools that we have built into the workspace for you guys in the MA test tab of MT main, will often be generating potential sort of pullbacks and things like that. Look at it all the time. We have it listed here today, but I want to just show you. We're just trying to demonstrate in this webinar some of the processes that we go through that you guys can do all the time to finding opportunities, with the award-winning TradeStation platform. All right, so some others that just popped up. I was scanning a little bit before the webinar, and some that did pop up over here that I wanted to mention very quickly was Norwegian Cruise Line Holding. This was interesting because this one came down the Keltner channel, and now it's at the 21-day exponential moving average. We have another tool on here on our. It's on. I'm sorry. It's on the price grid. It's called Keltner pullback, and when a stock is down near the bottom of its Keltner channel, it'll show up with a lower reading on Keltner pullback. So I'm not going to get into that now. I've talked about it a lot, but I did want to just show you guys that this was an example of one that was coming off the bottom of the Keltner channel. And what's interesting is you have a setup where like the 50 days above the 200-day, but it was low in the Keltner channel. Boom, that right there is a signal, and it shows that you have a longer term uptrend or an intermediate term uptrend, a short term pullback, and that can be an opportunity for people looking for continuation of the intermediate term uptrend. S&P dropping here. It's kind of interesting. I'm not really sure what's going on. It looks like we're actually now turning red on the day. I'm not really sure what the situation might be, so I'm going to let me take a really quick look, make sure I'm not missing anything. Make sure nothing happened. Maybe globally, you never know. So, all right. Um, Now, another one that was bearish that had come up to me same way. This will find bearish things is Dollar Tree. I mean, this thing has been a business model that has been coming unglued after a long period of outperformance. And so I wanted to mention this one here is kind of interesting. Same thing. It's hitting that falling exponential moving average. And this is one that has, more of a, the trend has been to the downside. You get an intermediate, sort of short-term bounce. And we're going to show there's going to be some potential opportunities in that. So anyway, I wanted to just kind of show a few option trades. We're always looking for ways to really use the power of complex option strategies to find sort of ways that we can um, you know make things work in the market based on what's out there. And I wanted to show a few here that kind of jumped up to me that was potentially of interest. And one of them was Apple, because we had mentioned we did an idea on Trading View. If you go back up here, Trading View is trying to hold a support level. So if you click over here and you look at our ideas on Trading View, I do wonder what's happening. If anyone knows anything, what's this? Can I share my trading view chart setup? I actually cannot. That is something you cannot readily share. But we basically did this thing on Apple holding this double bottom here potentially. So what's interesting to me about Apple here is a person could potentially look on Apple at look at how it's holding this level here around 170. So what was interesting to me was if we're thinking about selling options, the the best time decay, the sharpest time decay occurs kind of in the last 2 weeks. And so, looking for something like the 12th of April expiration, a person could potentially look for something in this one of like the kind of, the stock right around 170. Maybe now we want to move down a click if something is happening in the market. But the one I was looking at the time when I prepared this webinar was something like a person could click on the bid for 170, hold down control, and go to the 165s and the ask, and you're basically right there looking at um, hold 170 and then hold down control. And this spread, when I looked at it, was about a dollar. Now it's about a dollar 50. So if you want to go down maybe a little bit more, because now the market is actually potentially pulling back. If you click on the 170 and 170, I'm sorry, the 167 and a half, and then the 162 and a half, that spread now would bring in a potential credit of around 80 cents. So this was something that just kind of stood out to me because, if a person was to sell the 170, 165 put spread for about a dollar, it would essentially create an entry price of $1.69, which at the time I was looking at this, it's a little bit below the stock price, and it's occurring at a place here that is some potential support. So you have this potential double bottom. Now, the other thing that's important to me also about Apple here is earnings are out here on April, right around the end of April. This is an estimated earnings date. It's usually going to be the last day or two of April or the very beginning of May. So the thing is, is Apple going to break to new lows before earnings? One of the things I've noticed is that very often earnings there are liquidity events for investors. So the thing is that if you actually have, this liquidity event coming, people very often wait until that event if they're going to hammer the stock. So it can just enter a period of kind of benign drift here. And when you're sitting near a support level, selling put spreads under that are a potential way to take advantage of that. Now, Dollar Tree, on the other hand, with this kind of, bad earnings report here, bad earnings report here, it's interesting to me to look at something like this because the stock here is right above 130. So, I mean, this is 130 right here, and this is 120 right there. So that move is not particularly large, but if we look over here on our Option Station Pro, and we look to the month of May to give this one, now this is not a potential credit spread. This would be a debit spread, which means that a person would be paying money. But if you look to the downside in a name like this, a person could potentially look for a stock, to be clicking on the ask at 130, holding down control, and clicking on the bid at 120, and this spread is about 220, and that's kind of interesting because that is a spread that could expand to $10. So that's potentially kind of 3 to 1 risk reward. And again, look at the actual size of that. It's a move about 10% down in a stock that's been under pressure. And I think when you look at the overall chart here, a move down to 120 by the third Friday of May is not an overly big move. And the other thing is it has support much lower, closer to 100. So if a person was looking for this stock to really continue to the downside, this is potentially not a particularly important level for it to hold. People will be looking more to that 52-week low. So this is one that potentially might have some space to the downside. Now, PayPal is a stock that's been trying to rally here, but I mean, it's interesting to kind of see that there's some potential resistance here around 67 to 69. And when you look at these failures so far this calendar year, so a person in this one, again, now if we're looking for something like a debit spread, to basically make time for money, again, looking at that same expiration of the 12th of April, because that is where you're going to have the fastest pace of time decay. A person could potentially look on this one to maybe being like, we could look here to be selling, potentially, if you want to be selling calls with a call spread, selling naked calls, something that you don't want to be thinking about doing because it's a highly risky strategy. But when you sell calls, if you click here on the bid, and then you would buy the 69s potentially. This is just for kind of educational purposes here, but this would be a $2 wide spread for about 40 cents. Now, when I prepared this webinar not that long ago, the spread was more like 50 cents. So I had kind of prepared these examples. The market pulled back, but I think you can kind of see what's interesting about this is as long as the stock stays more or less under 67 through the end of next week, that 40% simply becomes a credit that the person would keep. And if you look now at the 67 level, you can see it never really closed above 67. So to me, this is one that I wanted to just kind of point out as being a way for people to play this resistance up here. This resistance is not very far away from the recent high, and you have a double top there. You have a gap back here in August that it seems to be providing some resistance. So selling the call spread to the upside is something people might look to do. Now another one just popped up to me that I'm just noticing today is McDonald's. McDonald's having some trouble with some of their business overseas, some kind of political stuff happening with them. And what's interesting to me is when these things start to go bad, they generally get worse before they get better. I mean, eventually, a company like McDonald's will find a way to fix everything up with and but the thing is that this is a relatively new story. It's only emerging in the last couple of weeks and maybe kind of taking a step up today. So it's interesting. My name here, McDonald's, as you can see here, that we're seeing those lower highs, short-term bearish descending triangle, and a name like McDonald's here. It's interesting. Let's take a look at the May expiration to the downside potential. Downside spreads. A name like this, a person might be looking for McDonald's. The stock's at 273. And if we look here at McDonald's and we basically go to the ask, hold down, click on the ask, go to the 260s, hold down control to represent a sell on the bid. And that is a $4 wide spread for about $2.50, which is also a kind of 3-to-1 risk reward. And again, a level of 260 on McDonald's here, is not massively, far down. I think especially when you consider the fact that McDonald's now does seem to be in something of a range from 300 down to like kind of 245. It's just this range here. So this spread would not even require hitting the bottom of the range. And so, like I said, this is also a bearish descending triangle. It's now under the 200-day moving average, So this is actually here something where people might look for the kind of downside. So I wanted to just kind of throw up some of these ideas really quickly. All right, now I'm going to turn off Option Station Pro because I don't want to overwhelm my computer because I'm about to pull up a bunch of news articles I want to zip through very quickly with some of the important things that I've been watching and want to talk about. Oops. Oh, God, it's coming up on the wrong monitor. Let's see if I can get this. Let me pull this over. All right. I use a tool called Tabox. It allows me to save a whole slew of tabs that I can then kind of share with people. So it has a whole series of articles I'm going to zip through very quickly. I'm going to hide myself so you can see them. So anyway, just wanted to show those ideas, whatever those options, concepts were for educational purposes only. But it's one of those things where the one thing I'll say, I'm not going to show you how to do it this time but TradeStation allows you to identify those underliers that trade a lot of options. So I'm always kind of looking. I mean, very quickly, I'll just show you how it works on this. If you go to like MA tools, you can see here that we have wait a second, on price grid. All right, well, on either of these, average options volume, this thing is set up to highlight when underliers trade a lot of activity. And so, you can just cut out the ones that don't trade, say 20, 30, 50,000 contracts a day, and then hone in on those that do and just look through them and look for potential chart setups. That's what I often do. And it's so valuable to have this functionality on TradeStation to actually see who are those active underliers. And that's why we shared this as a special indicator we created for you guys that allow you to see it so clearly. It just has a highlight functionality built in that if you right click on this and you actually go to studies edit, you can actually change the threshold for highlighting it. I have it set to 10,000 contracts a day. You can make it something bigger. But anyway, let's go back over to some of these big articles we want to talk about. So this is interesting here is that Citi basically says stocks have scope for further rally amid sustained futures and ETF inflows. We've seen a bunch of people kind of raising estimates recently on the S&P. I think it might have been Goldman. It was David Costin. If you actually look on our market insights on the blog, we did an article. It has the oil drillers on it on Market Insights, and basically, actually, I have it over here. I'll show you. If you look on this, we have a series of people talking about this article here. If you look down this article, it's a different article, but if you look down, we have a series of kind of summarizing calls that people made last month. What experts are saying, you might want to check that out. It was David Costin at Goldman who said 6,000 on the S&P. So these are just some of the, you might want to just take a look at this. We published this one. This comes out at the beginning of every month. But anyway, it was just interesting. Citi's just saying there's just, the ongoing flow of money into risk assets. Positioning is not stretched relative to history. Now, we've talked about the significant amounts of money on the sidelines in cash money market accounts, cash and money market accounts at brokerage firms. Anyway, so this is just kind of consistent with that. Now, let's take a look at some of these other things. I want to show you just something else that is to me kind of interesting. We have an indicator we look at, which is just kind of um, it shows how long the 10-day moving average is rising. And it's a very simple kind of indicator, but it allows you to see kind of how extended is the market in any direction. And interesting, the VIX is kind of spiking now. I almost feel like there's something going on. Like we're going to look at the news wire and find that something maybe happened or something. But my point about see, this is now changing. A lot of the things I was prepared for 40 like minutes ago are kind of changing. Um, I'm going to skip this because I feel like there might be something else going on that we're not aware of. The key thing was just that during this uptrend in 1995, you can see that the 10-day moving average would rally for like it would climb for a large periods of time with very short like pauses. And to me, this was an indication of a very strong trend. And in some ways, we have been looking like that, since we broke out back here, since we really started running in November. So I wanted to point that out. You can see this very small number of things turning negative. I'm going to just close these. Let me know in the chat if you guys are aware of anything happening. Um, This is interesting. We're continuing to see M&A becoming more of a narrative. I want to just share this. This one came up today. This one is, to me, something that I believe we need to be focused on because, M&A has not been a driver in this market for a long time. It's starting to emerge as one, and it's interesting to see this happening right here. Okay, so now we have. Um, this is interesting. This is a guy, Carl Quintanilla, who's one of the anchors at CNBC, just talking about how the stock market is going to, there are some people looking for it to start actually, boosting consumer spending. In the 90s, there's this idea of the wealth effect, and I've made comparisons to the 90s before, so it's interesting to see other people pointing this out. This other article here um, was something from Bespoke, and they looked at things from the Atlanta Fed, and they also saw that businesses are now getting more confident in their revenues, more confident in hiring. So in many ways, we saw a long period here of negativity that are both kind of turning higher, and I think that's kind of interesting. The Institute for Supply Management was unexpectedly positive this week, and that also kind of shows that this sort of improvement in the business cycle is there. One of the things we've been arguing, or not arguing, but at least mentioning. Now we're back under that important level. Remember, we started off by showing you this level on the S&P. Now we're taking it out. See this old high and this 50% retracement? It's going to be interesting to see how the market closes in the afternoon. I'm going to just go ahead and proceed, and we'll hope. Well, we'll see if something else pops up. I want to mention this, but again, this idea of increasing home equity, again, wealth effect building, and I think it's important to realize because for me, one of the narratives I've had, and I believe that people have really overlooked this fact, which is that essentially the American economy has been in a coma for the last 15 years following the financial crisis, and even before that, because of globalization and because of the jobless recovery we had way back in 2003. We had a lot of things that reduced consumer demand, reduced employment, reduced investment, and all those things now are going in the opposite direction. We're also getting more fiscal stimulus. So you put all those things together, and we have a little bit of a situation here where I think people are underestimating the real strength of the economy, and these things are continuing to come through. We're starting to see numbers like we haven't seen in a long time, and that's one of the things here that I want to make a point of is that coming out of the financial crisis, people were really sucking wind for a long time, but we're at a point now where there's significant kind of equity and wealth out there, and that wealth can beget other wealth. One thing also we've talked about is the fact is that inventories have been very lean, and as companies start to increase production, they have pricing power, and that means they're going to have margin expansion. So I think that's another thing right now. I continue to see the potential for a double whammy of improved margins, but also improved top line because of the strong demand and because of things like, where is it? This is from the Atlanta Fed. Look at the GDP estimate shooting up as GDP goes higher. Remember, the Fed in their last dot plot, their economic projections, they raised the GDP forecast for this calendar year. So stronger economic growth drives the top line, better margins drives the bottom line, and those two things seem to be happening at the same time. So that is an interestingly, potentially positive environment for risk assets and for equities. Okay. JP Morgan here. All right, now let's get into the troubles with Tesla. Just want to kind of emphasize, and we've been talking about this really for a long time on this webinar. We basically were talking about Tesla is just another consumer product. Now, maybe it's a little bit of an exaggeration, but we kind of compared it to a Walkman or Mr. Coffee. We said over time, consumer products, whether you like it or not, the prices go down. I can't believe how cheap when I was at Walmart the last time buying, looking at, big screen TVs and just how cheap these things have gotten. And I think we have to remember whatever you think about Tesla is a consumer electronic, and consumer electronics go down in value over the years. And Tesla right now is in that kind of worst spot because they themselves are not only facing increased competition from Ford and Toyota and these Chinese firms, but they're also in a spot where they're trying to introduce new products, which means that the current products they have are the old model. So it's kind of like, who wants to buy the old iPhone or who wants to buy the old Walkman? And that's essentially what Tesla's put itself into. And I think really it's important to realize that Elon Musk has not managed this well. So it's interesting. Now people talk about Musk's reputation going down. I really think that this was not handled very well strategically. The idea of ramping up production of a product and then turning around and saying we're going to another product, they've really set up a perfect storm of margin compression. So I just thought this was a case where they've messed up a lot of things. And I think it's important to just realize that now we have Ford, pivoting away from all electric. So as the narrative turns away from all electric, toward things like hybrid, and hybrid becomes the key narrative. Now, remember, we were talking about Toyota like 2-3 months ago. We were talking about how Toyota had the strongest chart in the auto space, and now it is now just the leader in hybrids. But I mean, the problem is Tesla doesn't have any of that. So the thing is if people want hybrids, they're not going to Tesla now, and the investors are not going to go to Tesla, and it still trades at higher multiples for the most part. So it's really a difficult set of forces coming together. JP Morgan slashed their estimates back on those bad deliveries. This is the Ford thing. This was the thing about people don't like Elon Musk now. Something about a market intelligence firm, which basically said that his polarizing persona is reducing the ranks of would-be Tesla buyers. So it's just interesting to see that the consideration score fell from 70% in 2021 to 31% in February of this year. So there you go. Now remember, when companies trade at high multiples, they need everything to be perfect. When they start having little blemishes, that causes multiple compression. It hurts valuations. So Tesla's really in that really messy spot there. Now, remember, we had been talking a lot. If you follow TradeStation, make sure you follow our social media channels because a lot of these things we had been talking about and we've been covering in different ways. I'm just pulling up these tabs so I can zip through them quickly. Now, let's see. We talked about this one, Tesla. All right. This is an interesting one with the guy, Charlie Bello, I follow sometimes. Look at the average price of a used Tesla from 69 or 68K to 31K. Pretty amazing, this one. This is something that Charlie Bello put out back on April 2nd. So this is the used Tesla prices. Again, same sort of thing. Remember, if you look back a couple of weeks ago to our previous market trends, we talked about this idea of pricing and margins, the catalyst for stock movement. And this was one of the things we said: when you see pricing going in a bad direction, that's bad for margins. Remember, I would say the three most important catalysts for stock movement are volumes. Volumes are when companies sell more stuff. Margins is when they make more money on what they sell. And then macro things like interest rates moving or oil moving. Those are your three biggest catalysts for stock movement, most prevalent catalysts for stock movement. And so Tesla right now is in a spot where they have significant margin problems and significant volume problems. And I think that's important to realize. And volumes and margins very often move together. They don't always, but when companies have weakening volumes, margins very often go south as well. So this just shows the biggest miss yet on deliveries for Tesla. All right, this is just a little thing about Suncor. Now, if you look down um, our rundown here, we basically feature a mover of the week. We like to look at companies that are kind of important companies, but are not in the S&P. They're not as well known. And what's interesting about a name like Suncor is it's this Canadian oil sands producer. Now, we've been talking about the upward pressure in energy, and at this point, I'm not really sure, what my kind of outlook would be for energy. It's had a decent run here, and it's starting to get, a little bit of, I think, herd mentality on it. But it's interesting, though, just to recognize this company, Suncor, which is SU, um, is a Canadian oil sands producer. And, this might be one to kind of keep an eye on. And, it's had this run here. But what's interesting is if you look at it on the weekly kind of time frames, it's broken some resistance here, and you can see. So from my perspective here, this could be one that imagine you had it on your radar screen with EMA test. Maybe in 2 to 3 weeks, it's going to glow 21 EMA because maybe it'll pull back to that EMA. And the way to do that is by going here to your price grid and putting it on there. And I'm sorry, MA tools. Go to MA tools. Like for example, if we put Suncor SU, it just shows up. See, it's all blank, right? But if it pulled back to that 21-day EMA, it would glow. It would light up right here in this box. Let me actually hide myself again. Sorry. So just something I wanted to mention. This is an article about Suncor, and what's interesting here is this is a margin story. They're cutting costs to drive, the profitability per oil. And the thing about the oil sand producing companies is they tend to be higher cost producers, but that actually means that when oil starts ratcheting up higher, they go from being not very profitable to being very profitable very quickly, which means they can generate more leverage on the underlying stock price. And if we do get to a point when oil enters a downtrend, they also can suffer the most to the downside. So I wanted to mention this one, SU. Okay, now turning to the Fed, Mary Daly is a voter again, and she says there's no rush to lower interest rates. So what's interesting here is we're looking at the Fed, and they're both kind of saying, three rate cuts, but we're not in too much of a hurry. What's interesting to me here is that we are seeing some news develop that I think could be highly, um, you know, kind of, it seems to be dovish despite some of the economic data. And so what's interesting here is that they are sticking with the idea of rate cuts, which is interesting. And now this is a new policymaker, Adriana Kugler. I've never seen her before. She joined the Fed for the first time this year, and so she's also talking. So the key thing is that these guys are all singing from the same hymn book, and they're all following the same idea of rate cuts. Don't want to be rushing anything. And I think that is really the thing that we want to watch. As long as the messaging stays on that line, that's where the market kind of is going to be looking. Bostic is back, and he's actually now the kind of seems to be the most hawkish of them. But I saw some other stuff here that stood out to me. The Eurozone has been showing a lot of negative inflationary pressure. So Eurozone inflation adds the chances of a rate cut in June. That is, interesting. And now if we look to this guy, Ken Griffin, hedge fund guy, he's getting more bullish on bond prices, which would also be consistent with the Fed cutting rates. So I'm going to just close some of these tabs. So again, we're seeing a kind of strength of this narrative of people looking past the early inflationary pressures that we had early in the calendar year, like they did last year. They're looking for these early sort of bumps, which are often caused by different kinds of, seasonality adjustments in the government that are statistical anomalies. People are looking for these things to fade and for us to get back on the narrative of a weakening of lower interest rates calming inflation. And I think that's interesting because there's a lot of cash on the sidelines. And like I said, if we see a weakening of the US dollar and we see a peak in interest rates, there's a lot of money out there that, will be potentially wanting to take more risk. All right, so Eurozone consistent with the dovish argument. Ken Griffin consistent with the dovish argument. Um, so it's interesting also here is the ECB is looking to go for, I don't have the date. I apologize. I might have it. Let me look on my other monitor really quick. I think I have the date. So basically, the ECB is going to be the canary in the coal mine. So I know normally we don't pay attention to what the European Central Bank does, but we might want to start paying a little more attention, just knowing when these events come up. And I'm looking over. Let me see. Their meeting. The ECB is on April 11th and then June 6th. So June 6th is potentially that sort of thing. But the April 11th meeting, Lagarde might say something also. There could be some messaging. So now could be a time when the European Central Bank and the European inflation reports could start to have an impact, because the expectation is that even with the Europeans cutting, that in theory should be, good for the dollar, but that's not the way that the market's thinking about it now. The market is basically saying that when the ECB goes, where the ECB goes, the Fed will follow. So the key thing is Western Europe and the United States had similar inflationary situations, and their interest rates move in a similar path. So the ECB could be the sort of leading decision maker, and they're probably worth watching. So I wanted to mention that this is the way people are starting to really view it. Okay, today we had a little higher job cuts, which is modestly sort of bad for the economy, which at this point in time, little bits of negativity for the economy are a good thing. We have those non-farm payrolls tomorrow. It was interesting last month was we saw strong job growth, high unemployment, low wage growth, which is really a perfect environment if you want to be bullish. It basically shows that the economy is strong and inflation is moderating. The economy is stronger than we thought, and inflation and wage pressures is weaker than we thought, and that's the sort of thing that I'm sorry, I got to turn this. I had a price alert set up on my other computer, and now it's just going crazy. All right. I'm probably not the only person who sets price alerts and then they suddenly go off and start, you know, flashing during meetings and other stuff. All right. Here's an interesting article. These two different articles I saw, basically saying exactly what I just said about payrolls. And the key thing is that as the overall employment situation moderates, wages are not actually running too hot. And so this article here, let me get back over to it. It's basically saying that we can grow 265, 270,000 jobs a month without inflation. So this article kind of said that the initial job claims shows that the best job markets in the half century in a half century with wages outpacing inflation. And this thing from this guy at Bloomberg, Steve Matthews, basically said that we can get big payrolls gains without pushing unemployment lower and creating inflationary pressure. So this is a Bloomberg economics piece. Again, these guys are kind of echoing what we would see. This is Steve Matthews at Bloomberg. I think he's one of their economy reporters or columnists. So again, we're just seeing the same sort of narrative of a Goldilocks story emerging. Meanwhile, the Chinese data is a little better than people feared. We had the best data there in a while. And so now, the other thing I want to turn to is what we've seen in gold. We're seeing this buying in gold by central banks. We've seen gold advancing. We've been talking a lot about silver, but I think it's important here we kind of look at this, is that we're in a situation here where, gold, silver, copper, these things have been dead for a long time. And if we move into a period of economic strength, China not being terrible, and the Fed moving toward rate, cuts, the strength that we have seen in copper, we have talked about these names like Freeport, FCX. We had talked about it back here when it broke this downtrend, and it's just been explosive. TECK. We had talked about this. We had talked about, and this is a little bit different, but Lyondell Basel. We had talked about LYB, and we had talked about Eastman Chemical breaking these levels. There were these weekly levels that were 52-week highs that went back to basically mid 2022 or early 2023 on all these different charts. And we were talking about them as they came off these levels. So a lot of this trade has now worked. It's priced in. And, in terms of where the Fed is, it's not necessarily, these are names now where, we might be in a spot of waiting for pullbacks for a couple of weeks for people to potentially look for these. But I think it's interesting to see that, and we've been kind of talking about these and they've played out. And I think it's interesting here to see that there is fundamental support for what's happening in the gold market and things like copper and stuff. These have been dead for so long that if people are looking for longer term trends, they, they might have that potential to last for more than just a few weeks of rally. What I'm saying is this could be the beginning of a significant continuation in some of these material stocks like Freeport, like some of the gold miners, like silver itself. And we talked about silver. If we took here really closely, I want to just get this. Let me get back my trading view chart here, because if you look at silver on like a weekly or even a monthly, let's look at silver on a monthly. I mean, look at this. I mean, basically, silver here actually went up to like 50 a long time ago, but look at how tight it's really been since COVID. It had the initial surge. I mean, to me, this is something where this could be, people have been wanting to see silver rally for a really long time. And it has been like Lucy in the football. Every time you think it's going to do it, it just jerks it away. But if there is a potential time for that to happen, strong Chinese economy, Fed rate cuts, lots of cash on the sideline. So I think silver is one of these things where people might want to be watching it, because it could be something where we've watched it for a long time and been frustrated for a long time. And it would be a shame if people were watching it and had messed it up, and then suddenly when it really does take off, we missed it. So this is something I think we want to keep our eye on here, because it could be, an interesting extent, potential. But look at copper also. Copper really just moving sideways here. This is a monthly chart of copper, but you can see here that essentially, it's gone nowhere since like 2010. So again, these are an area that people are not used to looking at, but it is, I think, an area that people are starting to look at. And if we get the confirmation of a dovish Fed, these are areas that might only be starting. Um, so basically, these guys are all saying here that, commodities. Basically, these other articles are commodities like copper, especially gold and oil are the two that I was looking at here. There's this whole thing about cocoa. People are going to talk about cocoa and coffee and stuff. And if anything, I mean, that's irrelevant to a lot of uh, you know, people trade, because these things are not heavily traded commodities. However, if it creates the narrative of things like commodities and stuff, it could actually drive interest in stuff like copper and gold, because it's a commodity and people are not interested in commodities for a while, for many years. And if this could fuel that interest. So the last thing I want to end with, and I meant to do this last time, was if we look here at the, all right, bulls pivot, the key news, and then we go down to, um, I'm just going to go down here to, well, let me not forget to tell you, of course, non-farm payrolls tomorrow, but in some ways, Wednesday the 10th could be a bigger day, because we have CPI in the morning and Fed minutes in the afternoon, and then we're going to have earnings season start after that. So I think that's just kind of something to be aware of. I didn't put it on this, but the ECB is on the 11th. So from the Wednesday and then that Thursday, this could be, a big thing. And it's interesting if the Fed comes out and they just kind of say, we're waiting, we're not, and they remain non-committal. Attention then turns to things like, earning season, and then we enter a period of time where we have about a month and a half until the next Fed meeting. And during that time in May, we'll have another economic report. But between mid-April and kind of and the end of May, we're going to have, there is a Fed meeting in there, but the big Fed meeting people are going to be watching is going to be on June 1st. So we kind of are setting up for a period of time here where attention can turn back away from the Fed and toward earnings. So the last thing I want to show you now is using the platform. I get in the actual, there's a zip file here if you want to grab this, and it's called bars since X move. And so I'm gonna see if I have time to show you the actual easy language. I'm gonna bring up a chart really quick of just like let's just go to S&P, go to like daily. And so what this thing does is, and you go to studies, if you've imported the study already into your TradeStation platform, and then you go to bar sense X move, I'm going to just, all right, so let's say that this is set for 5. So this is going to show how many days since the S&P rallied 5%. You go up here, and let's see. Let me actually change my data. I might not have it set to enough days. I'm going to go to, yeah, wait a second. Let me set the 30 years back. All right. There we go. So this day right here was a big move. This rally was this was a big rally on November 10th. So that was where of 2022. That's right. So basically, this is telling you here it's been 349 days since the S&P 500 rose at least 5% in a single day, and it was this big candle here. So what it does is, I'm going to very quickly take you into the easy language. I'm going to go to edit easy language, and what this does is this. Next time I need to turn off those alerts on my other computer. I apologize. What this does is this will run through the data, and it will basically accept the threshold, which I have set to 5%, and then every day it calculates the change. And if you're looking for like a 5% move, it says if the move is a positive number and it's above the number, then in that case, we're going to start counting. And what it simply does is it marks the current bar, which means boom, right here we got our number. I'm going to save that number in memory. It starts all the way from the left. So this is probably bar like 10,000, and this is bar like 10,349 or something, because it's 30 years of data. We don't care what bar it is. What we care is the difference between this and the most recent. So at the end, it goes down and it basically calculates the output value is the current bar minus where we started the counter. Very simple. It's a nice little tool. Remember, you can do all sorts of things like this with TradeStation. Let's just change this really quickly to, let's see the last time the S&P fell at least 3% in a day. I'm going to change it to -3. And now let's look. The last time it did that was one of these moves back here. That's a long time. I was hoping for something more recent. Let's see the last time it fell at least 2% in a day. Oh, now the last time it did that was back here in in February of last year. So it's been a long time. So it's one of these things where you hear people, say, "Oh, it's been so long since a move of X% or something like that." This will allow you to see it all the time. So let's just very quickly look at, who is right now on MT Main. Let's see who is moving the most in the S&P today. For example, I don't have that loaded, but if you look at something that's down a bunch, you could even say something like, let's just change it to like Tesla, for example. And this is now set to showing how many days since a 2% drop. And you can see here it had a 2% drop and it went that long. So anyway, I think you guys see how it works. The key thing with this is that what it does is you want to change the threshold and then it counts it. The other nice thing is that it also works for any time frame. So you can change it to like weekly, and then it will count how many times, since a certain drop happened with the weekly. So it can work for all sorts of different, you can say, when's the last time, Tesla fell 10% in a week, something like that, and it will count. And you can see that's a big, ugly week, and see then it starts counting, and then boom, it has a big drop right in this week, and then it starts counting again. So this is, like I said, it's called bars cents X% move. So want to always share that and show that it's so easy to customize TradeStation and come up with all sorts of things that work for you. So I will be back on Thursday at 2 p.m. Eastern, same time. It's great to be with everyone. Don't forget to check out TradeStation.com. Look at our ideas on TradingView and some of the things we do on social. Follow us on social. Great to talk to everyone. I'll see you next week. Thanks a lot.